Hey Zingers, welcome back to another Benzinga interview. I've got a great guest for you today, Steve Schofstall, Director of ETF Product Management at Sprott Asset Management. The tickers are GBUG, SGDM, and SGDJ. He's joining us for an exclusive talk. Get ready because the interview starts right now.
It's great to be here. Thanks for having me.
Absolutely. So do you mind giving the viewers a little bit of a rundown of what your ETF is and how you guys sort of manage gold?
Yeah, so we have three gold ETFs. They're all focused on gold miners. The first one is the Sprott Gold Miners ETF, ticker SGDM. This is a passive base, so it's an index-based strategy. It's a little bit different than what you see from your traditional index. It does have some factors in there so that we're trying to just not only match an index, but also look through to the companies and pull out a few certain characteristics. The way the index works is, it starts from the available investor universe. And from there, it starts to look at factors such as revenue growth and long-term debt to equity and free cash flow yield. Those are then used in the weighting process. Similarly, we have a junior ETF, Sprott Junior Gold Miners ETF. That's ticker SGDJ. Very similar in that it is a factor-based index, though it is index-based. That's important to note. This is going to focus more on those development and exploration type companies. So the way the index works is it focuses more on the small cap side of the universe. Those companies that are involved in the exploration, they're going to have a factor of price momentum, which is going to help to determine the weight within the index. Producers are going to look at revenue growth. So again, it's a different way of looking at it from a pure, just passive index strategy. And then our newest fund, the Sprott Active Gold and Silver Miners ETF, ticker GBUG. This is a fund we're really excited about, just launched in February, has already reached over $100 million in assets. It's the only actively managed gold miners ETF on the market. And what this really does is it leverages our investment team that has over a century of experience in the gold mining space. And this fund, being an active fund, it does kind of follow those old school active principles. Where investment team is conducting over 200 management team meetings per year. They've also traveled to more than 40 countries going to individual mine sites. And typically those mine site visits number around 30 a year, give or take a few. And what they're doing when they go on those mine sites is they're looking to, one, not only understand the operations of the company, but it also allows them to really talk to all layers of employees, management, and folks on the ground that are actually doing the operation and doing the mining on any given basis. So it's a really exciting product lineup that we're excited about it. And GBUG is one that's really been embraced by investors right out of the gate.
Wow, that's awesome. So I feel like when we speak about gold, we can't not talk about the physical asset. So what has been some drivers that's really pushing gold higher, physical asset wise?
Yeah, so gold's had quite a year. As we sit here, early October, it's been up about 48% year to date. It's trading somewhere around $3,800 per ounce, a little bit north of that. Typically what we see out of gold is that it tends to do well when you start looking at economic turmoil. So things of like currency debasement, geopolitical instability, economic uncertainty, falling interest rates, all of these things that we see presently in the market. And because of that, investors have really flocked to gold over the last year. We actually see, if you look at all global investment funds, about 13.5 million ounces have been purchased on the market in these funds. So investors are clearly flocking to the physical asset. There's another aspect that plays into this. When you think about gold, it tends to be different than other commodities. And that's because central banks are actively buying in the market. Over the last 3 years, we've seen central banks purchase over 1,000 tons of gold per year. And we see consistent buying throughout this year. And China, in fact, has actually purchased gold each month for the last 10 months. So they're continually adding to their stockpiles. And the logical question is, why is that happening? And I think a lot of that goes back to geopolitics and what we see on the global landscape. Countries are viewing their gold reserves as a way to get around potential economic sanctions. It's also a way that they can bring gold back domestically and store it within their own country. And, in our view, it's really a way that countries can move to de-dollarize their reserves. And those are kind of the two macro themes that we're seeing really play on the physical gold market.
Yeah, no, it's really amazing to see gold up over 40% in this past year. That's mind blowing. So, with gold setting new records, how have gold miners been impacted by this?
Yeah, this is one that's perplexed people for a number of years. If we go back to the last bull market around the start of the last decade, so around the 2010, 2012 time frame, gold miners actually performed very well relative to gold. Well, this most recent gold bull market, that's a number of years in effect now, gold miners have been lagging. And a lot of that is kind of this hangover effect that we had of the last bull market. There was a general sense over the previous gold bull market that oftentimes the miners weren't allocating capital efficiently, whether it's going into mergers and acquisitions or there were cost overruns. We're seeing that's different this time around. There's a general consensus within the sector that miners are being much more intentional with new projects that they're going into and paying much more attention to their financial stability. These record gold prices that we're seeing are making these balance sheets much more healthy from the gold mining perspective. And what we've seen this year is miners have actually overtaken the physical bullion in terms of performance. If you look at SGDM's index, it's up around 120, 125% year to date. And all of this is happening in a time where we're not seeing investors actually buy gold mining ETFs. Those ETFs are actually at about $4.3 billion in outflows year to date. So a lot of the investing public really hasn't embraced gold miners to this point, yet we're still seeing this very positive performance.
So, what would you say to those investors who see price appreciating in gold miners and may be hesitant to enter the sector at this point?
Yeah. So for us, we think there is still room to run in the gold trade, particularly in the gold miners. And some of that is because we haven't seen investors move in mass into gold mining with those outflows that we've seen. Typically what you see whenever you have a sector that's moving significantly higher, like we see with gold miners, you tend to see a lot of capital come behind it from the general investing public. We just haven't seen that happen yet in this case. And in our view, the gold mining trade isn't a crowded trade at this point because we haven't seen those large inflows come in. These companies are benefiting from higher gold prices relative to the S&P 500. What you typically see out of a section of gold miners is that they tend to be about 60% as expensive as companies in the S&P 500. The dividend yield is about 40% higher, less leverage, less debt, profit margin that's about 86% higher. And on top of all of these metrics, what you tend to get out of gold miners is a level of diversification across most major asset classes when you think of the S&P 500, US dollar, bonds, and other asset classes as well.
So, earlier you mentioned how Sprott Gold Mining has three ETFs. How are these strategies different between the funds?
Yeah, so the first two, SGDM and SGDJ, so the all cap and the junior miners, those are passive strategies. Factor based, as we discussed. The active strategy, GBUG or GBUG as we call it, really does allow the portfolio management team to bring their expertise into the ETF and manage the product in a way that they feel can potentially capture upside potential within the mining sector.
Okay, cool. So, what would you consider? What should investors consider when deciding between active and passive strategies?
Yeah, it really is up to investor preference. So some investors might not want to take on active manager risk and might prefer a passive strategy, and that's a total valid way to go about portfolio construction. For investors that want to consider an active strategy within gold mining, it tends to be particularly helpful in miners in general. And when you start looking at the dispersion of returns, so if we're looking at performance of the top performing companies versus the bottom performing, we tend to see that there's this wide gap or the return dispersion. Over the last 5 years, that averages about 170%. So meaning the top performing stock outperforms the bottom performing by an average of 170%. That's a one-to-one ratio, but if you were to drill down within the broader universe, even more than that, what you see is the top quartile of stocks within the gold mining industry over those last 5 years, with the exception of 2021, where there were a couple of companies with negative performance, have experienced positive performance in all those years, whereas the bottom quartile, by and large, has seen negative performance. So it's not just about the top performer versus the bottom performer. There's this middle section where there's still a lot of difference in return potential and what we see on an annual basis and can really impact the investment outcome. So this is where an active strategy for investors that are comfortable taking active manager risk, where they may be able to benefit from what we're seeing within the mining industry. But at the end of the day, there really isn't a right or wrong answer, passive or active. It really comes down to investor preference and risk tolerance.
All right, awesome. Steve, thank you so much for being here today. Absolutely amazing, really great stuff, and such great information you've given us on Sprott ETFs.
It's great to be here. Thank you.
Thank you. An investor should consider the investment objectives, risks, charges, and expenses of each fund carefully before investing. To obtain a fund's prospectus, which contains this and other information, contact your financial professional, call 1-888-622-1813, or visit SprottETFs.com. Read the prospectus carefully before investing.